Welcome to PNJ Training. In this section, we explore the current expected credit loss framework in depth, focusing on the seven-step process that governs every allowance estimate and on pooling, the most judgment-intensive part of the entire model. The first thing to understand about the current expected credit loss standard is that it is a framework, not a formula. It is not a one-time year-end calculation. It is a structured process applied at every reporting period, whether you are estimating the allowance for the first time or updating it for the 10th consecutive quarter. The same 7 steps apply every single time. The 7-step engine begins with input and segmentation. Step 1 is to identify all in-scope financial assets. That means every financial asset carried at amortized cost, trade receivables, notes receivable, loans, held-to-maturity securities, and net investment in leases. You need to confirm that nothing has been excluded without a documented basis. Step 2 is to segment those assets into pools by grouping together assets that share similar credit risk characteristics. Assets that do not share characteristics with any pool must be assessed individually. Steps 3 and 4 move into estimation and rates. In Step 3, you select the estimation method most appropriate for each pool. The standard permits several approaches including aging schedules, loss rate methods, vintage analysis, roll rate models, probability of default and loss given default models, discounted cash flow analysis, and the weighted average remaining maturity method. You document the rationale for whichever method you choose. Step 4 is to develop historical loss rates by calculating actual write-off data from your own records for each pool, ideally covering a complete economic cycle. Steps 5 and 6 are where environmental adjustments come in. Step 5 requires you to compare the conditions that existed when your historical data was generated to conditions that exist today. Where material differences exist, you apply adjustments. Step 6 layers on qualitative adjustments, known as Q factors, for conditions not fully captured in the historical rates. You also apply an economic forecast for the reasonable and supportable forecast period, and then revert back to historical rates beyond that horizon. Step 7 is the final output. You apply the fully adjusted loss rates to each pool's outstanding balance. You sum across all pools to arrive at the total required allowance. You then compare that required allowance to the current balance in the allowance account, book the adjustment to the provision for credit losses, and reconcile the result back to the balance sheet. That reconciliation is essential for auditability. Now let us zoom in on the pivot point of the entire model. Step 2, pooling. Pooling deserves particular attention because getting it wrong distorts every single calculation that follows. All assets placed in the same pool are estimated together using one loss rate. The pool definition you establish at the beginning determines the quality and defensibility of your entire current expected credit loss model. The core rule of pooling is straightforward. Group assets together based on shared credit risk characteristics. Critically, those characteristics must genuinely affect the probability of loss. The standard does not prescribe exactly which characteristics to use. You design your own pools based on the nature of your portfolio. But every asset placed in the same pool will share a single loss rate, so the grouping must reflect real economic similarity. Segmentation dimensions fall into 3 broad categories. Customer or borrower characteristics include industry sector, customer size such as large enterprise versus small and medium enterprise, internal credit rating and relationship history. Asset or contract characteristics include the asset type, collateral type, payment terms, maturity, and vintage. Economic characteristics include geographic region, currency, and historical payment and loss patterns. A well-designed pool reflects meaningful combinations of these dimensions. Here is the wrong way to approach pooling: applying one flat rate to all receivables. This approach is generally unacceptable under the current expected credit loss standard. It distorts unique credit risks that exist within the portfolio and invalidates the model by masking the real differences between customer segments. A single flat rate is only permitted in the rare situation where a portfolio is genuinely homogeneous, meaning there are no material differences in credit risk between any customers or assets. Here is the right way: segmented pooling. Consider a company with customers across different industries and geographies. Instead of one flat rate, the company defines 4 pools. Pool 1 covers domestic construction customers with a historically observed 5% loss rate. Pool 2 covers domestic manufacturing customers at 2%. Pool 3 covers domestic retail customers at 3%. And Pool 4 covers international customers at 7%. Each pool receives its own historical rate, its own current conditions assessment, and its own qualitative factor adjustments. The required allowance is calculated separately for each pool and then summed. What happens when an asset does not fit into any pool? That is the outlier situation, and it requires individual assessment. A large, one-off note receivable with unusual contractual terms, for example, may not share meaningful credit risk characteristics with any group of other assets. In that case, the loss estimate is derived independently for that specific asset using the same general framework but applied to that asset alone, not derived from a group rate. The current expected credit loss framework is a precision engine. It is a continuous and repeatable process, not a one-time event. Precise pooling at Step 2 drives the accuracy of every estimate that follows. The key takeaways are: document your pool definitions, defend them with evidence of shared credit risk, and repeat the full 7-step process every reporting period. In the next section, we will cover the 6 permitted estimation methods used in Step 3 and how to choose the right one for each pool. Thanks for watching. If you found this useful, subscribe to PNJ Training for more videos like this. Thank you for watching. Subscribe for more training from PNJ Group.